Hey everyone, Glen James here. Thanks for listening to My Millennial Money. I'm joined by
John Pidgeon.
And John, are you pumped for today's episode?
I am so excited.
I love when we talk about first home buyers because it's such a fun and exciting time.
It is.
That everyone should get to experience in their life.
Hopefully.
And I want to just, set the scene with, we're probably going to be talking more about buying your first home to live in as opposed to buying an investment property and reinvesting.
Yes.
Now, we will cover some strategy stuff if you're going to leapfrog the home that you start to live in and all that. But primarily, buying your first home as a principal place of residence. Now, I just want to let everyone know we've done a crap load of webinars recently, and you can watch the replays on our YouTube channel, M3TV. And also if you want the audio version only, we've got another podcast called My Millennial Replay. And all the audio versions of the webinars are on the podcast app.
That's
now,
cool.
John, talk to us about your online academy, because that's just been going off the shelf like hotcakes at Pancakes at the Rocks at 2:30 in the morning. So it's material to everyone listening today because, yes, it has an investment focus. It will also frame the discussion around buying your first home to live in strategically.
Yeah, so one of the modules within that is absolutely buying your first home to live in, or buying your home to live in as your principal place of residence, which, as you said at the start, 99% of Australians will probably want to do that at some stage in their life. So yeah, it goes deep into that specifically, but the modules, there's 14 of them in total. We've just added 2 new ones literally last week. So foundations of what you want in your life in respect to goals and mindset and habits, obviously your cash flow, back end system there. Deep dive into investment strategies and what you need to look out for. Yes.
Oh no, I was just going to say that be careful, because if you do the academy, you might work out that rent vesting's for you.
Yes, and we have had that, which is a great thing to have, because there's no right or wrong.
No, that's right.
And that's what we're talking about today. We talk about hot spots and not spots. We talk about how to put in offers, how to deal with real estate agents, just how hard we have to work to actually go and find property ourselves.
It's funny, to the trolls on Reddit who don't like what we do, there was a comment I saw on there. It's like, they don't know anything about share investing. They only talk about rent vesting and all this stuff. It's like, no, we're a personal finance podcast. We cover everything. I don't care if you rent vest. I don't care if you buy to live in. I don't care if you only salary sacrifice to super. So check that out. There's a link in the show notes.
There is.
And of course, we can't do this podcast without Sun Super, who is our show partner. If you are looking at superannuation, make sure you throw Sun Super in the mix. And the month of September this year, it's going to be called Super September. Don't know if I've told you, John, but every episode we're doing in September will be super focused.
Beautiful.
So we're going to do one on buying a property in your super, self-managed super, and dealing with the gender super gap.
Yeah.
We've got somebody, the CEO, Phil Usher, coming on from the First Nations Foundation to talk about money and the Indigenous community. And we're just going to cover everything to do with super.
Yeah, that's cool. And that's timely, because one of my new modules is actually superannuation. Wow. So that's a good one.
We'll look at that. So remember, Sun Super, if you're new to the podcast, they've got a very cheap admin fee, $1.50 per week, plus 0.1% up to $800,000. And if you want a really low-cost super fund, you can actually build an indexed fund within your super, because their index options is basically a rebadged Vanguard.
Yeah.
So you could basically build your own Vanguard diversified high growth fund with your Sun Super.
Yeah, that's cool.
Yeah. So, well, let's have a chat.
Let's do it.
So we're going to break down this episode, and hello everyone if you're watching on YouTube, into maybe 5 sections. The first one is we're going to talk about the finance and the money side. The second section, we're going to talk about strategy, location selection, property type. The third section, we're going to talk about the individual property selection. So once we've ciphered down all our strategy and we know we want a bloody 2-bedroom townhouse on level 5 of a block or whatever you want to do there, then we'll talk about the negotiation when you're negotiating to purchase the property. Then we'll talk about some other stuff around, what could be stopping you from buying a property. And then we're going to read what the community said. So we've got pages of Facebook comments here, and we're going to share with you what you guys are saying about your experiences.
Yeah.
So I guess, John, I'll throw to you first, just in terms of the money side, someone wants to buy their first home, and I would also encourage, if you already have your first home, you still might be able to learn from this episode when you go to buy maybe a second property. So don't turn off just yet if you're still listening. So purchasing our first home, money side, what are your initial comments?
So I think broadly speaking, we've got deposit, how much do I need? We've got how much can I lend? And we've got what are my repayments going to be? And then we deep dive into all three of those areas and the way we structure those finances. But I think understanding, we've got our strategy, and we'll get to that in a moment with location and whatever, but how much have I got as a deposit to put down, and what loan-to-value ratio am I going to go in with? Is it 10%? Is it 5%? Is it 20%? Now, my views on buying your own home to live in, generally speaking, I would say we'd want a 20% deposit, but that's not always possible depending on the location that we want to buy in.
So as an example, you talked about loan-to-value ratio, and in the biz it's called an LVR. Now, if someone was to purchase a $500,000 property and they did have $100,000 cash saved as a deposit, that would be an 80% loan to value because they've only borrowed the $400,000, which is the loan, and the value is $500,000.
And I literally came from a meeting right there with a client that was doing exactly that.
Really?
They've got their 100, 500 was their purchase price.
Wow.
And we spent about 15 minutes on the whiteboard just saying, well, what are our options here with deposit amounts? And knowing that, and this is quite common for first home buyers at the moment, is I've got these government grants going on. I've got my stamp duty concession. I've got home builder if it's new, right? For him, it's going to be existing, but he's still going to get the stamp duty concession. It's only his own home for the next 6 months or 12 months before he moves out of it for it to become an investment. So we've got that side of things as well to think about, haven't we?
Yeah, and before we get into the strategy part, I'm going to play an audio file from a listener who has just purchased their first home.
Yeah, cool.
And it's interesting on that whole deposit side. But I guess, we've just thrown around $100,000. That's a crap load of money. Very rare for, the average person out there to be able to save $100,000. So I guess my vibe, generally speaking, in terms of the money side of the debate, is you really want your cash flow systems nailed.
Yes.
So whether you've got your own spreadsheet or your own system that you use, and it could be, we just pay everything into an account and then we just take money out and spend it, and whatever's left we save.
Yeah.
Whether it is, a 10-10-80 type of budget where we give 10, we save 10, we spend 80. Whether it's the Glen James spending plan, which many listeners have done. Thank you for supporting me and doing that plan. So whatever you do, you've got to have some type of system because it will allow you to get intentional with your money.
Yeah, absolutely.
And then I'd probably say you really want to try and nail that consumer debt first.
Yeah.
So park the car aside and don't excuse the pun, include the pun. But even if we just, for the sake of this conversation, if you've got a car loan, just forget about that for now because it might be possible to get into a house with a car loan.
Yeah.
But particularly if you've got credit card debt, if you've got afterpay accounts, if you've got personal loans, if you've got GE money or whatever all that stuff is, when you get a cash flow system in place, it will really help you with the overspending.
Yeah.
Because a lot of the time, the consumer debt, it isn't because you've bought a $2,500 lounge once off. It's death by 1,000 cuts over a longer period of time of overspending.
Yeah, and it'll hurt you when you go to the banks to ask for money as well, won't it?
So kind of as a running track that I've used with clients in the past is, let's get a money system in place. Let's nail our consumer debt. And then I want you to aim for a 10% deposit of the property value if there's no parental guarantee, if there isn't any other options. But I guess what I want to talk about is, before we go to a mortgage broker, and I wrote in my notes, like, talk to a mortgage broker probably when you're on the serious path. So I think if you don't have a money system, if you got debt coming out of your ears, like, all you need to know now is you got to be out of debt, and I need you to aim towards at least a 5 to 10% deposit.
Yeah.
Because a mortgage broker is only going to tell you that.
Yeah, I think the
Maybe.
mortgage
I can't
broker...
speak on behalf of the mortgage brokers.
No, but I think the mortgage broker meeting can actually be the motivator, because sometimes we're going through life, we're saving money, but we don't really know what we're saving it for, or we're not saving money at all. But to have a big ticket item there out in front of us, and for the mortgage broker to say, well, if you can get yourself 75 grand saved up, then the bank will be able to lend you 400 grand. Straight away, that may be the motivator, that turning point that says, right, I can actually get that 75K a lot quicker than I thought.
Yeah, and that's what I mean. I just don't want you to waste a mortgage broker's time if you're not on the serious path.
Yeah.
Like, if you haven't resolved within yourself, or if you're in a relationship that, we actually do want to buy a home.
Yeah.
And it might be, let's put in the diary, in 2 months' time, we're going to contact a mortgage broker. We've got 2 months or 3 months or whatever to at least get a money system in place, to at least have a pathway of smashing some debt.
That's right. Yeah.
But if you're debt free and you have a money system in place, and if there's two of you in the relationship, you might be like, oh, we can both save $1,000 a month. Absolutely. Chat to a broker. Say, hey, we wanted this type of property in this location.
Yeah.
Can you give us a realistic running track based on the situation?
For sure. Yeah. I think you can't go and see one early enough, but you can go and see one too late.
Yeah. And we will kind of get to that as well, because there's some experiences from the Facebook group that we will share where it speaks to mortgage brokers. So I guess I just want to probably say, just get on the serious path if you are wanting to do this. And a 10% deposit, I mean, you can get into a property depending on your job. Like, if you're a professional or a doctor, lawyer, accounting, sports person, there are instances where banks and lenders can be more favorable to you. And I guess there are options with parental guarantees. And again, if you go and have a listen to our First Home Buyer webinar, or on John's podcast, My Millennial Property, or even search our episode tree. I don't want to spend our time talking all about parental guarantees now, but in our ecosystem, there are heaps of stuff on parental guarantees and how they work. So again, you could be income heavy, living in a location that sucks the living rent out of you. It might be an option to have a parental guarantee and get into a property next Thursday. Yeah.
And the whole lender's mortgage insurance is an interesting one too, isn't it? Like, number one, each bank has their own LMI set of rules. So there's not a calculation that you can say, well, this is how much we're going to pay. It's a case-by-case basis. I've seen scenarios where a client's been with a bank for 8 to 10 years, and the LMI was actually halved because of their loyalty to that bank. Now, I'm not saying stick around with the same lender, but it definitely helped them in that situation. So in a lot of cases, the LMI, my personal thought is, it's the cost of doing business. If it gets you what you need and you can handle the repayments, that might be 6 or 7 grand that you don't get back and you don't see value in. However, it might have got you into that suburb that you wouldn't have been able to get into at that particular price because you didn't have the deposit amount. By the time you actually saved that deposit, that suburb value had gone up and you'd missed that particular cycle.
Yeah, and for those who are completely new to this money world, LMI is lender's mortgage insurance, which basically means if you do not have a 20% deposit, the bank or the lender will charge you for an insurance policy. And that means if you don't pay, they can claim on the mortgage insurer to make sure they get their money.
Yeah.
So just on that, I'll give you a real practical example. When I purchased when I purchased my first home that I lived in, which happens to be where our studio is because we're sitting in my garage at the moment.
Yes.
I had the option to use a parental guarantee to not pay lender's mortgage insurance. Mm-hmm. However, I took the view that I didn't want to tie mum and dad up or worry them, or, you know, they were probably relocating in a few years. So I just didn't want to make the whole situation complex.
Yeah.
So I actually paid, I think it was maybe $13,000 or $14,000 or $15,000 lender's mortgage insurance to buy this property.
Yeah.
Now, within the first year of owning this property, it went up $100,000. So, and I borrowed the cost of the lender's mortgage insurance.
Yeah.
So the net kind of wash up is, yeah, I paid more, but in my situation, I resolved that a lender's mortgage insurance wasn't a big deal, and I didn't want to tie mum and dad up with a parental guarantee.
Yeah. No, fair call.
So just on the whole mortgage situation, we'll assume that you are debt-free or very much on the track. We'll assume that you are engaging a mortgage broker. And if you do need a mortgage broker, just go to sortyourmoneyout.com, click get help, and we can introduce you to one of our trusted brokers. We've now got brokers basically all around Australia, which has been really great. We've had great experiences with our listeners getting trusted people. So when you are, you know, we are in a low interest rate environment. Over the next few years, once the economy starts to kind of, you know, take off and recover, there's probably only one way mortgage rates are going, and it's north. It could be in a long period of time. I think we'll be in a low interest rate environment for a long time. That's just me hypothesizing.
Yeah, I agree.
I think we are in for a longer season of low interest rates, but I think it's always wise to factor in possible interest rate increases. Absolutely.
Yeah. In any case, I would always factor in 0.25% or 0.5% as
you go up to 0.5%?
Yeah.
Ish. Yeah.
It does depend a little bit on the times, as you said, record low interest rate times that we're in, and also getting a gauge on what fixed rates are doing as well. Now, at the moment, you can fix rates at 2.5% or under. The variable rate's slightly higher, generally speaking, than that. So what's that telling us? Well, logically speaking, the banks are not in it to lose money. So if their fixed rate is lower than their variable rate, they're probably telling us that their variable rate's not going to go up anytime soon. It'll probably come down.
If you were a first home buyer today, knowing what you know, and we'll use that example we talked about, a $500,000 property, you know, you got $100,000 from, you know, inheritance, or you saved it, and you're getting $400,000 loan, would you go a fixed or variable interest rate?
Yeah, it is a case by case. And if I pre-frame that by saying in the last 20 years, I've never fixed a loan, right? But loans, interest rates generally have, variable rate has always beaten fixed, right? And as we said before, the banks really lose on that. So if my income was maybe low and the cash flow in my life wasn't great, and I was not petering on the edge, but just understanding that it was every dollar counts, I would probably get a little bit of security in the fact that I know what my payments are going to be for the next 2 years or 3 years. If I was in a job that was not 100% bulletproof, like teaching or nursing or something like that, then I'd also maybe look at fixing it. So it really depends on the situation.
And a good mortgage broker will talk you through these options and just help you workshop it. I mean, when I bought this place, 75% of the loan was fixed.
Yeah.
And then the balance was an offset and all that stuff. But I actually broke that within the 5 years because I had another opportunity. So it kind of had to pay an exit fee.
Yeah.
And then in the second year, the property went up another 100,000. So I certainly didn't lose out with this whole endeavor. But I guess my comment on the fixed and variable would be, I like frameworks.
Yeah.
If, as John said, you've got a good income, rock solid job, bit of wiggle room. Yeah, sure. Variable, knock yourself out. we'll just can't beat the bank. And that's my view now. Can't beat the bank anyway.
Yeah.
If you're on the other end of the spectrum, running on the line, tight, you would do the fixed possibly. But for those who are unsure and might sit in the middle, to my point, you're allowed to do half-half.
Yeah, you can do 70-30, 50-50, whatever you,
and
allows you to
we are going to talk about, some fear stuff later on in the episode, and maybe part of the fear mitigation with the mortgage, it could be a portion of that loan that is fixed. Because I think we both kind of agree that in this climate, the fixed is usually, or more so, for that emotional stability.
Yeah, just guaranteeing the sleep at night, knowing what your repayments are going to be and sticking to it. But yeah, it's a lot of disadvantages in fixing rates.
Yeah. So there you go. So another thing I want you to consider, and I'll probably get John's advice on this. I kind of wrote when you are, shivers, drop my pen. I kind of wrote when you are considering buying your first home, is there a family on the horizon? Do you have a family? Will one of the partners need to take an extended time off from the workforce with a low or reduced pay or no pay?
Yeah.
So we've got to make sure. And do you think there's a rule of thumb, like if there was a couple who went to purchase a home who they're like, we want to start a family within 12 months. Do you think there's a rule of thumb? And I'm just thinking 12 to 18 months in my mind. Make sure you factor in that before you pull the trigger, if it's within that 18 months, maybe. Yeah. I mean, if you're 21 and you and your partner go and buy a house tomorrow, and it's like, no, we just want to live or whatever. Like, do you think there's a...
Yeah, I think, and this isn't a topic on should I buy my own home to live in or should I buy an investment property, but I think what I get people to think about is looking deep into the future of the next 5 or 7 years, and speaking to that family scenario is, well, if I have got a family in 5 to 7 years, then that's nearly school age. So where are my kids going to school? Well, I haven't even thought about that because I haven't even made a baby yet. So, but understanding that that's a really strong possibility if you're in a permanent relationship and you both want kids, that if I go and buy a property now to live in, is it going to be my area for the next 8 to 10 years? And I would question someone, if it's not going to be for 8 to 10 years, why are we doing it?
Why are we purchasing a house to live in?
In that particular location,
right,
if it isn't our long-term location in that respect.
Yeah, right. And Michael, in the group, Michael Connaughton, I think your name is, he wrote, he could afford repayments even if my wife went off for a baby or interest rates went up. So he really made sure that the financial side was nailed.
Yeah, that's perfect.
And I would even say, like, I was talking to somebody on the weekend, they were wondering, I've got this amount saved, can I get into a property tomorrow? I'm kind of thinking, well, you don't want the whole experience that should be a blessing to turn into a curse. Make sure you've got some cash buffers in your life.
Yeah.
Because the day the property settles, you could walk in, it could have been empty for 2 months, turn the hot water on and pop, hot water system shat itself.
Yeah.
Like you just don't want to be running your life on the line.
No. It's all right to do when you're single and you've got no responsibilities.
And then I kind of on the financy thing, and I will say the mortgage broker that you engage will be able to help you around the government incentives. The government, state and federal at the moment, at the time of recording, printing money for a lot of first home buyers. So you really need to capitalize on that free money. For me personally, when I bought this place, the planets really did align. I mean, if I was buying in this suburb now, I wouldn't be able to afford it. But at the time, it was a brand new property. So I got a $10,000 grant. It was my first home. So I got, I think, another $10,000. So it might have been 15. Like, it was very opportune.
Yeah. And it was an area you wanted to be in.
Yeah, totally. Yeah. And I'll make a note when we talk about the strategy about my friend Cal and Nath, and we're going to get these guys on the podcast because we talked about their kind of strategy.
Yeah.
So finances, it's a huge part. Another thing, John, and I don't think mortgage brokers or banks or lenders will allow it, if there's a single person out there who, you might want to buy a home, they might say, well, I'm going to have friends rent a room off me. Banks and lenders generally won't factor in board for servicing, will they? It's got to stand up in its own right, and any board that you get, you can just put that towards the loan after the fact.
That's right. Yeah, they'll factor in a rent if it's going to be an investment, but if it's going to be your own rock, then no.
Yeah. So and that's kind of the kicker. Like if you've got a really good income and you're like, I can buy this house.
Yeah.
It's a 4-bedroom. I've got 2 friends that want to move in. I can get $150 a week from them, or whatever that is.
Yeah.
Yes, you've got to get in there first.
Yeah.
And then you can print the money from renting the rooms, but
that'll pay the groceries.
You can't factor in that because it's very much speculative income anyway. Like it might not happen, it might happen.
Yeah, and I think that leads me to think, well, the banks will lend you X amount, but can you afford X amount in your life? Because what they lend you is not necessarily what you can afford.
Yeah.
And that's where I'd be looking at speaking to the mortgage broker and saying, well, give me 20 banks and their servicing criteria for me and my personal situation.
Yeah.
Guaranteed there'll be 150K discrepancy from banks, from the top through to the bottom over those 20 lenders. So that's where going to your one bank only has got rocks on it.
And this is where, like, you might see an ad on TV saying this building society will do 1% interest or whatever.
Yeah.
Yeah, but in the fine print, they'll only do an LVR 50-50 or something like that.
Yeah, that's right. Yeah.
Because it's all about risk.
Yeah.
Now, I've just written here, as a rule of thumb, I generally think your net income, you don't want more than 25% of the household net income going towards rent or mortgage repayments. Up to 30, sure. 20 is amazing.
Yeah.
0 is awesome, because if it's 0, it means you own the place.
Yes.
But if you can kind of have 25% of your net income going towards rent or mortgage repayments, that does not include insurance or electricity, because you pay that anyway.
Yeah.
But just headline mortgage repayments.
Yeah.
And that will, because I believe over 30%, statistically, you're in mortgage stress.
Yeah, and when you look on the Australian Bureau of Statistics website, they use the 30% indicator as well.
Yeah.
So, yeah.
So that's, we might put a nail in that coffin for finance. But I just hope in this discussion, it's just got you thinking about how you can make sure the money side of it is lined up. If you are doing like a side hustle, or if you've started your own business, you've really got to chat to that mortgage broker or lender, because you might have to be self-employed for over 2 years with some lenders before they can allocate that income. Or if you want to use your side hustle income, they might be needing some proof that you've done that side income for over a year. So again, like, I just want to finish on, like, you can't get your financial advice from 2 dickheads on a podcast, like, because everyone's situation's different.
Do you know 2 dickheads on a podcast?
Yeah.
You've heard about them. Yeah. So, but just on that, and I'm dealing with a client at the moment that's in this situation. She started her business in November.
Yeah.
And she came to me last week and said, I'm not going to be able to get a loan because I've only started my business in November. I said, is it trending well? She said, yeah, it's really good. The last BAS was really solid.
Same industry as she was employed?
Same industry, yeah. I said, don't put a line through it, love. So we went to the...
What are you, a grandfather, are you, love?
Yes, she's actually older than me as well. Dicey. No, but there was loans out there for her.
Yeah.
So I think when you read that garbage about we need 2 years of financials to get a loan, well, yeah, in an ideal world, you have 2 years and you've got 50 lenders to choose from.
Yes. However, that's absolutely correct. And I say it's just to kind of be dramatic in the fact that it might be a consideration. Like if you want to go to one of the big fours, they're going to be a lot stricter with how they lend, because it's all about risk management and it's not the Wild West.
Yeah.
But if you've got any second or third tier lenders whose lending, they might charge a higher interest rate to make up for that risk. So it's horses for courses.
Totally. But again, understanding what's out there, and then you can make that informed decision.
And I guess that's why I asked if it was the same industry, because the lender might say, well, they were employed as a manager at, Deloitte, for example. Now they've gone off as a management consultant. There's a clear track record here that they've got a contract that's signed for 2 years. And I mean, I'm going beyond the scope of what I know.
No, that's good.
Generally, anytime I pick up a microphone, but anyway, we're here now.
No, that's why you're here.
I want to start the strategy section with a voiceover that came in because we actually did have Asher booked to come in today, but he was called into work. So I reached out to the community and I got somebody just to share a bit around their story, and it was interesting to hear this, and you might need to come over if you can't hear this, but all right, let's have a listen.
Hi Glen and the M3 team. This is the story of my partner and I buying our first house. Prior to starting to save for buying a house, I moved in for his parents so that we could save to go on a big holiday, and decided after that we'll consider saving for a house. We thought it would maybe take 18 months to 2 years, but it actually only took us 6 months of saving before we saw a mortgage broker and realised we could probably buy a lot sooner. That was partly because he was a good saver, and because of my job I did a lot of extra casual work, and as a health professional I only needed a 10% deposit. His parents also offered going guarantor for us, and in the end that worked out a bit better because then we could keep a lot more savings as a sort of cash buffer. So we started researching in October, and then ended up looking to buy in January, February, but every house we looked at went for 10% more or about 100 grand more because we're in Melbourne, which is an auction city. So we got a bit disheartened, and as unfortunate as it is, COVID actually helped us because we made an offer on a house that had got passed in, and due to lockdowns, no more private inspections were allowed, and they actually took our slightly less than what they wanted offer. So we actually only moved in yesterday, very exciting. So some key takes is that I started a spreadsheet in October, months before we wanted to buy, noting recent sales in the area. I looked at a lot of data. We also made notes on the real estate app statement of information price guide so that when we went to an auction and it went for a lot more, we could remember how much it was offered for. A mortgage broker really helped as well. They guided us through doing a guarantor or using my 10% offer because of my job, and also being just quite friendly to real estate agents but not telling them too much. It ended up that we saw a lot of properties, we went to a lot of auctions, we did a lot of building and pests, but we still did end up finding the right one, and it was all worth it.
So thank you, Laura, for sending that in. So John, I was just writing down so many pearls of wisdom there that they kind of went through. Was there anything that stood out to you most with her story in terms of the strategy?
Yeah, I think, well, not necessarily the things that she did. She evidently did a lot of research, which was fantastic.
Yeah, so she did 8 months, her and a partner, 8 months of research. And the spreadsheet,
I'm sure, was pretty elaborate, which is great, and that's what you need to be doing. One thing I picked up there was she said, we were going to auctions, and she's right, Melbourne is the auction capital, and they were 100 grand more. They're going for 100 grand more on the day. That's where I think a lot of people can get it wrong, because 100 grand more, is that worth what it's actually worth, or is that 100 grand more than what it's actually worth, right?
Yeah, is it inflated due to a couple of emotional bidders?
Yeah, because in some cases, take for example...
Which you could philosophically say things just sell for what people will pay for them, and that's what it's worth.
And that's what I'm getting at. With Laura, she's obviously done her homework to know, well, okay, this house is going to auction. It's not her first time that she's visiting an auction. On her research, she might have thought, well, this house is worth $1 million because of the comparable sales in the area, right? But it goes for 1.1. Well, that's 100 grand over what we think it's worth. The asking price on realestate.com or by the agent might have been 900,000. Okay, so there's very much a difference between the asking price and what it's actually worth, and then what it actually sells for. Right, that's where people need to really dig deep to get their research in order, because the asking price on realestate.com is not what it's worth. It's what entertains people to be interested in the property in the first place, and it's maybe what the real estate agent's putting out there as a price that may or may not be realistic.
Yeah, I thought the amazing thing that just jumped out when Laura started talking, like in terms of their strategy, they moved in with the parents for a short period of time. They use, things to their advantage, like the COVID crisis, and it sucks. There's winners and losers in everything in life, but if you can be strategic, you can be a winner. And the thing and I hear this time and time again, once people are dialed in with their money, speak to a mortgage broker, they can buy things or buy faster than what they thought.
Yeah. They've definitely ahead of a lot of other people who are just starting out and don't know what the hell they're doing.
Yeah. So all is not lost. So we're going to talk about strategy. But before we do, I've just decided, because I don't want to kind of rush this episode. So we're going to come back and do a part 2 about the individual property selection, negotiation, and some other stuff. But in terms of strategy, is it a freehold property with a big block? Is it a townhouse or is it a unit? Is it new? Is it old? Where is the house? Is it the worst house in the best street? So when we are buying our home to live in, is it true that we need to still be strategic even if we are going to live there for 8 to 10 years?
Yes. I think it's any asset that we're buying needs to have financial strategies around it, as opposed to just going in fully blown with emotion. I would go back a step and say there's actually 3 types of buying our own home.
Yep.
One is I'm going to live there long term, next 30 years, never want to leave this joint.
Yep.
2 is it's going to be my next 5 to 10 year home before I upgrade to my ideal location because I can't afford it right now. And 3 is I'm just abusing the system to get some homeowner grants, and then I'm going to actually move out in 12 months and turn it into investment property.
Yeah.
Yeah.
And I guess when you are strategic, so you make the money on the buy most of the time. If you buy at a premium and the market still goes up, well, hey, you'll make more money, but if you bought well to start with, you'll make even more. So I think if you are strategic, it allows for changes of situation and changes of circumstances. So if in 3 years' time, you get the offer of a lifetime to move the family or move whatever to Japan and work there for 3 years, all right, we'll sell this house. We're strategic at the start. So usually strategic means you've got more flexibility sometimes.
Yeah, that's right. And one of the 8-point strategies that I employ with my clients is location. Now, generally speaking, when you buy your own home to live in, you know your location, right? But where is that location sitting in the property cycle at any one time? Like you said at the start of the conversation that you bought here when you did and it went up 100 grand, right? Now, I don't know whether you researched the market and you're a gun property investor, which I probably think you weren't, in which case means that you bought luckily and it went up straight away. That tells me it was probably 2013 to 2014.
I think it was 14, yeah.
Yeah. So did we see that coming? Yes, we did, right? Well, I did anyway. So when we're looking at the cycles, understanding historically where the market's come from and not necessarily predicting where it's going, but just seeing how it's been tracking for the last 5 years.
Yeah, but to counter that, if you've got the money and you can afford to buy that place because you want to live in that area and it is a bit hot, well, I'm not going to tell people, just piss off for 3 years and wait. Like, you want to, it's that balance with how do I live my life with, I don't know.
That's right. And that's why I said there's 3 types of buying our own home.
Yeah.
Because if it is the next 30 years that we're going to be, couldn't give a bugger about the property cycle because it'll sort itself out. But if we want it to be a stepping stone to our dream home, then we want it to be a good buy straight away, don't we? So,
and I guess, I talk about if it is a hotter market and we're going to do that because we can afford it, that's not me. Well, probably is. I contradict myself 25-8, but I think you can still be strategic within that parameter.
Yeah.
So it's like we're extra maybe picky or extra hard with our negotiation. So there's always strategy.
Yeah.
It's not just, it doesn't matter, we're going to live there, let's just overpay like those people that we've met with down the road once.
That's right. And that's where we say we nail the macro indicators and we nail the micros. So the macros are, I'm buying in 2014, perfect time in the market because it's been flat for the last 5. And then I'm nailing the micros in that, okay, they've got on the market for 900, I'm going to offer 850.
Yeah.
So I've actually got the best of both worlds, which puts me potentially 10%, 15% ahead of anyone else in the game.
So with the, I guess the strategy play, they say the worst house in the best street. Like, is that an old wives' tale, or can it stack up?
I think it does stack up, and it's a personal favourite of mine. I wrote some notes here before: location or dwelling. Usually one or the other for most people. If you've got the psyche or the attitude of, well, I couldn't care less what I live in, it's the street that I want or the location I want, then fantastic. You can live in a dump and gradually do it up or do what you need to make it work. I think, generally speaking, you'll probably come out far superior than someone that just goes in and purely looks at the actual house as opposed to the location.
And I guess there's, with our strategy and I guess location selection and the property type, yes, what area is it? What type of property is it? Are we going to start a family within the next X amount? Do we need to think 2 steps forward with this strategy?
Yeah, totally.
And I think in terms of the strategy play, it's very much coupled with the finance play because, when we do the next part of this discussion in the next episode, when we talk about the individual property selection, once we've nailed the money part and the strategy part, we've got some real tight parameters that we can really nail down in terms of the individual property selection. So we're not spending our weekends going to look at 2-bedroom apartments with no ensuite when we value an ensuite.
Yeah.
So I think, again, you just got to nail the strategy. What do I want?
Yeah. And the great thing...
And why?
Yeah, absolutely. And the great thing about analysing our goals and what we want and then the finance is, byproduct of that, you've already looked at the markets because you've had to, because, well, what do we want? Where do we want to live? How much money we've got? Is that going to buy that in this particular area? So you've already done some research before you actually start the research.
Yeah.
So, which is fantastic for an overall outcome.
Yeah, and I think it's just, you just got to make whatever works. And is it, no, we just want to buy a home to get settled and start a family. We're pretty agnostic to the area, sweet. Or, no, I want to be 3 streets back from the beach or whatever. I've got to buy a bit of an older place and I don't really care for a family.
Yeah.
I mean, and this is why you can't get advice from 2 dickheads with a microphone, because we don't know your situation, but we just want to really prod you and really tickle your inquisitive side to really get you thinking. And I think in terms of the strategy, talk to us about you and Amy being in a relationship and how that strategy came into play. Like, you wanted the beach, she wanted the property. Was that it?
Yeah, I think we've spoken about that once or twice on previous episodes. But I came from land, agriculture. I loved the land, but now I wanted beach.
Yeah.
She wanted space.
Yeah.
Right. And it was a unique time in the market where 2.5 acres was actually similar price to walking distance to the beach. So finance-wise, it was apples versus apples, but it was more of a,
lifestyle.
Lifestyle. So how close are the kids' sporting activities? How close are the schools? Where do we want to be? Where are our friends? And what we valued in life. So thankfully I won out and we chose, and she didn't regret the fact that I won out. Because we know now the travel would have been the issue in getting kids into sporting activities and whatever. So you've really got to...
Location, were you looking at property? Like Glenning Valley or...
sort out even like Yarramalong Way.
Oh, wow, out in the valley.
So, yeah.
Yeah, that's... Wow.
Yeah, so which we would love to be out there one day, but it just wasn't for us in our time in life. But if we didn't fast forward 5 years and think about that a bit more strategically, then we could have ended up with egg on our face. Now, it wouldn't have been the worst decision, but...
And because egg's delicious.
Eggs, especially poached. Are you scrambled or poached?
Oh, that's funny you say that. I oscillate. Like on Sunday,
Of course he does.
I had scrambled egg at the cafe.
Yes.
So different cafes, I don't know why we're going there, but like if I go to Glee Arena Heights, I'll get fried eggs flipped with some avocado.
Yeah.
If I want some sourdough, I'll go poached eggs on sourdough.
Can't beat it.
But it really depends what I'm feeling at the time.
Yeah, cool. So acreage, beach,
Yeah.
similar.
So, okay, so I guess in terms of the strategy, that's for people to really work out. And sure, go and have a look at a few homes. Get a vibe. You know, you look at enough homes, you know what's a bit of a nightmare after you've seen a few. You know, part of the strategy could be has to be tied to the finance.
Yeah.
So, we can actually only afford an apartment in the city. Okay. But then we've got to factor in some strata. So these are all moving parts.
Yeah, that's right. And I think it's interesting. Like I've done hundreds of clarity calls over the time, and I've actually made a few people cry as a result. Like not because I'm a mean person, but because what I told them was outside the box, and they knew it was probably in their heart that was the actual best decision, but emotionally they were grappling with this other concept that wasn't going to be the best result for them.
Yeah.
So it's really just understanding where does your emotion stop and your logic start.
Yep. And I guess I'll finish with this strategy comment, and then we'll read some questions from the Facebook group to bookend this episode. But a legitimate strategy for me personally was I wanted a townhouse in a location because I couldn't afford basically a freehold property. But I want if possible, a brand new townhouse.
Yeah.
Because I've lived here 6 years now.
Yeah.
But I'll never sell this place. So it had to be, I guess, brand new so I can get some depreciation when I do move out. So at least it's less drama for me, and I didn't want an older property and blah, blah, blah. So it just, because I really nailed what I kind of wanted, and I looked around, it kind of found me.
You are a new type of guy too.
Yeah, yeah. But again, if you want to fix a upper, it's going to be harder to do that with a townhouse because you got strata involved. You can't just paint your little corner of the world. So
no.
Again, just with your strategy, just think, do we want to get a brand new townhouse somewhere that's in an area that we would love to live in for 5 or 6 years, but we just keep it, and then when we do start the family in 8 years or whatever, then we'll move.
Yeah.
And I guess that's where your strategy and your clarity calls with Pidge are probably more what you need. Yeah,
and that, going back to those 3 types of home buyers, where the one where we're in it for 12 months and then we're out and it's just a wealth creation play or money saving because of the grants, that's really speaks to understanding what yield it's going to produce when you do move out of it, and not getting emotionally wrapped up in, does it need a pool out the back? Does it need this? Does it need that? When, hang on a minute, you're only living there for 5 minutes.
Yeah.
So same thing if it's only a 5 to 10 year plan. Well, can you make do for the saving of upgrading to your ideal home later on?
Jesse in the Facebook says, research your broker and look at reviews. Might have been burnt there before. Claire said, have a list of must-haves and stick to it when you're inspecting. It's easy to get emotionally sucked in to the pros of a property. And we'll talk about individual property more next episode. Nikki said, not being aware of a westerly facing land, especially in southwest Sydney, spent too much money to try and make house survival in summer. So again,
it is hot out there. I must agree with them there. But I think, generally speaking, it's an indicator, but I don't think it's a massive game changer. Something to keep into mind though. Know where your north is. Yeah.
What else have we got here? Oh, Callum and Nath, who we'll get on the podcast. You know, they've been working with John and his Envisage Property Services. You can reach out for John if you want more info. But basically, they live in Melbourne CBD. They've just purchased a home an hour out and they are going to live in it for 12 months. First home, they got a heap of government grants. And it's kind of good enough that they might like it out there and might stay there.
Absolutely.
But if not, it's a good quality investment property. So they kind of scratched both itches and probably got about 40 grand worth of government incentives, which is real money.
And the problem with guys like Callum and Nath is they're going to live in a brand new home for 12 months. Now that they leave that in 12 months and go back to not say a crappy apartment, but a smaller dwelling. So there's a bit of a...
Actually, just on that, we'll end now, but I'm going to make a note for next episode that we'll start with about buying with friends.
Yeah.
Because, you know, it just thought of me, I'd clarify Callum and Nathan are in a relationship, but what if there was friends that wanted to buy a home? So we'll leave it there. Thanks for listening today. And if you are listening when these come straight off the press on the Tuesday, in 2 days' time, we'll have part 2. So we'll see you then.
Bye.
Bye.